Welcome to our deep dive into the world of stock options. We're using options as a strategic investment as our guide. And trust me, this book is a treasure trove of knowledge. Forget those complicated formulas you might be picturing. We're going to uncover the power of options in a way that actually makes sense.
What I find fascinating about options is they're not just about betting on a stock going up or down. They let you create custom strategies based on how much risk you're comfortable with and what you think the market will do. It's a whole different way of thinking about investing.
I'm already intrigued. But before we get ahead of ourselves, let's start with the basics. For someone hearing about options for the first time, how would you explain what they are?
Imagine you're interested in buying a house, but you're not ready to commit just yet.
Yeah.
You might offer the owner a small fee for the option to buy the house at a set price within a certain time frame. That's essentially what a stock option is. It gives you the right, but not the obligation, to buy or sell a specific stock at a predetermined price, called the strike price, before a certain date, the expiration date.
Okay, so instead of buying the house, or in this case the stock, outright, you're paying for the choice to buy it later.
Exactly. And just like with that house example, if the value of the stock goes up before your option expires, you can exercise your right to buy it at the lower agreed-upon price. But if the stock price drops, you can simply walk away. And your only loss is that small fee you paid for the option.
Interesting. So it's a way to potentially control more shares with a smaller upfront investment and limit your risk if the market moves against you. Tell me more about these calls and puts I keep hearing about.
There are two main types of options, calls and puts. A call option gives you the right to buy a stock at a specific price, while a put option gives you the right to sell a stock at a specific price. Think of it like this. A call option is like betting the stock price will go up, and a put option is like betting it will go down.
Okay, I'm starting to see the possibilities here. Our source material specifically focuses on listed options. What makes those different from other types of options?
Listed options are standardized contracts that trade on exchanges, kind of like stocks. This makes them easier to buy and sell because everyone knows the terms of the contract. It also adds transparency and liquidity to the market, which helps reduce risk, compared to options traded privately or over the counter.
So it's like the difference between buying a car from a dealership versus buying one from a private seller. More regulation and oversight with listed options. So I'm looking at a specific option contract. What are the key elements I need to understand?
Every option contract has four essential parts. 1, type. Is it a call option, right to buy, or a put option, right to sell? 2, underlying security. Which specific stock is this option tied to? 3, strike price, the predetermined price at which you can buy or sell the stock. 4, expiration date, the deadline for exercising your option.
So let's say I'm interested in buying 100 shares of a company called Techco. It's currently trading at $50 per share, but I think it might drop a bit before going up. Could I use an option instead of buying the stock outright?
You could. Instead of spending $5,000 on 100 shares of Techco right now, you could buy a call option. Let's say you choose a call option with a strike price of $50 and an expiration date in July.
Okay.
If Techco drops to $45 a share before July, you could simply let the option expire and avoid losing money on the stock.
That's a lot less risky than owning the shares outright. But what if I'm right and Techco goes up to, say, $60 per share before July?
Then you're in a great position. You can exercise your call option, buying those 100 shares at the strike price of $50. Even though they're now worth $60 each in the market, you've essentially locked in a $10 profit per share.
Okay, now that's starting to get exciting. But how do I know how much an option will cost in the first place? What factors influence the price of an option?
Great question. Several factors are at play, and they all interact in interesting ways. The biggest influencer is the stock price itself.
Right.
Generally, as the price of the underlying stock goes up, call options become more valuable because there's a higher chance they'll end up being in the money, meaning it would be profitable to exercise them. The opposite is true for put options. They become more valuable as the stock price drops.
That makes sense. The price of the stock is clearly important. But what else plays a role?
Another crucial factor is time to expiration. The longer the time until the option expires, the more time the stock has to move in a direction that benefits you. This longer time frame adds value to the option, referred to as time value. But here's the catch. Time value decays as the expiration date approaches. It's like a melting ice cube. The closer it gets to completely melting, the faster it seems to disappear.
I can see how that creates a sense of urgency for option buyers. It's not just about being right about the direction of the stock, it's about being right about the timing, too.
Exactly. That's a critical concept to grasp. Then we have volatility, which measures how much a stock's price tends to jump around.
Okay.
More volatile stocks have options with higher prices because there's a greater chance of a big swing and a big potential profit or loss.
So if I'm looking for those big potential profits with options, I should be looking at volatile stocks. But that sounds riskier too.
It definitely comes with increased risk. If you're uncomfortable with big swings in your portfolio, options on less volatile stocks might be a better fit. Finally, interest rates also play a role in option pricing, although typically to a lesser extent than the other factors we've discussed.
This is a lot to absorb. It sounds like option pricing is a complex interplay of different market forces.
It definitely is. But understanding these forces is key to making smart decisions when it comes to buying or selling options. Now, there are two other factors that influence option prices, but they typically have a much smaller impact. These are the risk-free interest rate and the cash dividend rate of the underlying stock.
Okay, so we've got these major players influencing prices: stock price, time decay, volatility, and then interest rates.
Yeah.
And then the risk-free interest rate and dividends are kind of lurking in the background. But it's still good to be aware of them, right?
Absolutely. The more you understand about option pricing, the better equipped you'll be to make informed decisions. It's all about connecting the dots and seeing how these factors work together.
I'm ready to keep connecting the dots. Let's talk about some key option concepts. What exactly do we mean by intrinsic value and time value when we're talking about options?
Great question. These concepts are crucial for understanding how options work. Intrinsic value is the inherent worth of an option, based on where the stock price is right now, compared to the strike price.
Yeah.
Imagine you own a call option with the strike price of $50, and the stock is currently trading at $60. You could exercise that option immediately, buy the stock at $50, and then turn around and sell it for $60, making a $10 profit per share. That $10 profit represents the intrinsic value of the option at that moment.
So it's like the guaranteed part of the option's value.
Yeah,
Because you could exercise and lock in that profit right now.
exactly. Now, time value is the additional amount you pay for an option above and beyond its intrinsic value for the possibility that the stock price will move even further in your favor before the option expires.
So time value is all about potential and hope. It's like buying a lottery ticket, knowing it might be worthless, but hoping it will win big.
That's a good analogy. Of course, with options, there's a lot more strategy and analysis involved than with a lottery ticket. But you're right that time value reflects the potential for things to get even better. And as we talked about earlier, time value decays as the expiration date gets closer. So time is literally money when it comes to options.
I'm starting to understand why people say options are a wasting asset. If that time value is constantly decaying, there's a built-in pressure to make a decision before it melts away completely.
That's a great point. Now, let's talk about exercising an assignment. Those are the terms for actually using your option and putting it into action.
Okay, so let's say I'm holding a call option and things are looking good. The stock price is above the strike price and I want to cash in. What happens next?
That's when you would exercise your option, meaning you choose to buy the stock at the strike price. The option writer, the person who sold you the option, is then obligated to sell you the shares. That's called assignment.
So there's always two sides to this coin: the option buyer and the option writer. The buyer has the right to exercise, and the writer has the obligation to fulfill the contract if the buyer chooses to do so. It's like a strategic dance.
Exactly. And understanding both sides of this equation is crucial for successfully navigating the world of options.
All right, I think I'm ready to get a bit more specific. Our deep dive is focusing mainly on call options for this episode. What are some of the ways we can use call options strategically?
There's a whole range of call option strategies out there, each designed for different market situations and risk appetites. But we'll start by looking at two basic strategies that form the foundation for more complex approaches: covered call writing and call buying.
Sounds good. I'm eager to learn about how these strategies work in practice. Let's take a deeper dive into covered call writing first. What's the basic premise here?
Imagine you already own 100 shares of a company, and you're feeling generally positive about its future, but you're not expecting huge price swings. You could sell a call option on those shares, essentially giving someone else the right to buy your shares at a certain price.
I see. So you're already invested in the stock, and you're basically giving someone else the option to buy it from you at a predetermined price. What's in it for you?
The main benefit is you generate income from the option premium. That fee the buyer pays you for the right to potentially buy your shares. It's a way to potentially enhance your returns on a stock you already own. even if the price doesn't move much.
Ah, so there's immediate reward for selling the option. But there must be a trade-off, right? There's no such thing as a free lunch in the stock market.
You're absolutely right. The trade-off is that you limit your potential upside. If the stock price rises significantly above the strike price you set, if the stock price skyrockets, the buyer of your option will likely exercise their right to buy your shares at the strike price. Even if the market price is much higher, you miss out on that extra profit.
So you're essentially capping your potential gains in exchange for that upfront premium. It's a way to potentially generate extra income. But it comes with the risk of leaving some money on the table if the stock takes off.
Exactly. Covered call writing is often considered a more conservative approach, often used by investors who are generally neutral to bullish on a stock and want to generate additional income or slightly reduce their downside risk.
That makes sense. So it's not necessarily about hitting a home run. It's about generating consistent returns from stocks you already believe in.
Hmm.
I'm curious about the flip side now. What about just buying call options outright?
That's our second basic strategy, call buying. This is a more straightforward approach where you purchase a call option, betting that the stock price will rise above the strike price. If you're right, you can exercise the option and buy those shares at the lower strike price, then sell them at the higher market price for a profit.
Okay, so with call buying, you're not starting with shares you already own. You're making a bet on the direction of the stock and potentially profiting from the price difference. But what happens if you're wrong?
That's the risk. If the stock price doesn't move above the strike price by the expiration date, your option becomes worthless, and you lose the entire premium you paid. So, while call buying has the potential for larger profits than a covered call, it also comes with more risk.
Got it. Higher potential reward, but also higher risk.
Yeah.
Sounds like choosing the right strategy depends on your outlook for the stock, how much risk you're comfortable with, and how much time you have until the option expires.
Exactly. There are many factors to consider, and that's where things get really interesting. We'll delve deeper into the nuances of these strategies and explore more advanced options techniques in part 2 of our deep dive. Welcome back to the deep dive. In part 1, we talked about the building blocks of options, those calls and puts, the factors that influence their prices, and even started exploring how to use them strategically.
We dipped our toes into the world of covered calls and call buying. But now, I'm ready to roll up my sleeves and see how these strategies play out in real-world scenarios. Let's start with covered call writing. Can you walk me through an example?
Absolutely. Let's say you own 100 shares of a company we'll call Coffee Co.
Okay.
And it's currently trading at $50 per share. You're feeling pretty good about Coffee Co. long term, but you don't expect a huge price jump in the next few months.
Sounds like a perfect scenario for a covered call.
It could be. To write a covered call, you would sell a call option on those 100 shares.
Okay.
Let's say you choose a July call option with a strike price of $55, meaning the buyer has the right to buy your shares at $55 a piece anytime between now and July. And let's say you receive a premium of $2 per share for selling this option.
Okay, so right off the bat, I'm pocketing $200, $2 times 100 shares just for selling this option. I like where this is going, but what are the possible outcomes from here?
Well, let's say Coffee Co.'s stock price stays below $55 by the expiration date in July. In that case, the option expires worthless. The buyer doesn't exercise their right to buy your shares, and you get to keep the entire $200 premium. Plus, you still own your Coffee Co. shares.
That sounds like a win-win. I'm making money even if the stock doesn't move much.
Yeah.
But what happens if Coffee Co. has a great quarter and the stock price jumps up to, say, $60 per share before July?
That's where the trade-off comes in. If the stock price rises above the $55 strike price, the buyer of your call option is likely to exercise their right to buy your 100 shares at that price. You're obligated to sell them those shares even though the market price is higher.
So even though Coffee Co. is now trading at $60, I'm locked into selling at $55 because of the option I wrote.
That's right. You're essentially capping your potential profit in exchange for that upfront premium.
Right.
In this scenario, you'd make a $5 profit per share on the stock itself, selling at $55 instead of your purchase price of $50.
Right.
Plus the $2 per share premium for a total profit of $7 per share, or $700.
I see. My profit is limited, but it's still a profit. And I'm actually making more money than I would have if the stock had just stayed below $55 and I only made the $200 premium.
Exactly. It's all about understanding the trade-offs. Covered call writing is often used by investors who are generally bullish on a stock but also want to manage their risk.
Okay, that makes sense. So with covered calls, you're not necessarily trying to hit a home run. You're trying to generate some extra income from a stock you believe in while also potentially reducing your downside risk. What about call buying? How would that work in a real-world scenario?
Let's stick with Coffee Co. for this example. Imagine you don't own any shares yet, but you're convinced that a new product launch in June will send the stock price soaring.
Mhm.
You could buy a July call option with a strike price of $55, betting that the stock will rise above that price before the option expires. Let's say this call option costs you $4 per share.
So I'm spending $400, $4 times 100 shares, for the right to potentially buy 100 shares of Coffee Co. at $55 each. What happens next?
If your prediction is correct, and Coffee Co.'s stock price goes up to, say, $60 per share before July, your call option will be in the money.
Okay.
You could then exercise your option, buying those shares at the strike price of $55 and immediately selling them at the market price of $60, making a $5 profit per share.
Okay, so I'm buying low and selling high, just like with a regular stock trade. But in this case, I'm controlling 100 shares for a fraction of the cost because I used an option.
Exactly. And because you bought the option when the stock was at $50, you're able to magnify your profits if the stock price goes up significantly. In this example, you'd make a $500 profit from exercising the option, minus the $400 premium you paid, leaving you with a net profit of $100.
Not bad for a $400 investment. But I know there's another side to this coin. What if Coffee Co. disappoints investors and the stock price stays flat or even drops?
That's the risk with call buying. If the stock price doesn't rise above your $55 strike price by the expiration date in July, your option will expire worthless and you lose your entire $400 premium.
Okay, so call buying has the potential for big rewards, but it also comes with the risk of losing everything if the stock doesn't move in the direction you're betting on. It seems like covered call writing might be a safer approach if you're already bullish on a stock.
It can be, especially if you're looking to generate income and aren't necessarily expecting a huge price jump. But remember, every strategy has its pros and cons. There's no one-size-fits-all approach to options trading.
So far, we've been talking about fairly straightforward strategies. I know our source material delves into some more complex approaches too. What are some of the advanced call option strategies out there?
There are many, but let's focus on two for this deep dive: ratio call writing and bull call spreads. These are strategies that combine multiple options positions to create different risk and reward profiles.
Let's start with ratio call writing. What makes this strategy different from a regular covered call?
With a regular covered call, you sell one call option for every 100 shares of stock you own. But with ratio call writing, you sell more call options than shares you own.
So if I owned 100 shares of Coffee Co., I might sell, say, 200 call options instead of just 100.
Exactly. This increases the potential income you can receive from premiums. Remember those $2 premiums we talked about earlier?
Yes.
By selling twice as many call options, you double your upfront income.
That sounds tempting. But there must be a catch. What's the downside?
The downside is increased risk. If Coffee Co.'s stock price shoots up significantly, you're on the hook for potentially selling 200 shares, even though you only own 100.
Oh.
You might have to buy those extra shares at the higher market price to fulfill your obligation to the option buyers, which could eat into your profits or even lead to losses.
This definitely sounds like a strategy for more experienced options traders.
It definitely requires careful planning, risk management, and a good understanding of your risk tolerance. But for experienced investors who are comfortable with more risk, ratio call writing can be a potentially lucrative strategy.
Okay, I'm adding that one to my list of advanced options techniques to explore further. Now, what about bull call spreads? What are they all about?
A bull call spread is a strategy where you simultaneously buy one call option at a lower strike price and sell another call option at a higher strike price, both with the same expiration date.
So you're buying one call and selling another, both on the same stock. What's the advantage of that?
The benefit of a bull call spread is that it limits both your potential risk and reward.
Okay.
By selling that higher strike call, you're generating income from the premium, which helps offset the cost of buying the lower strike call. This reduces your overall investment and defines the maximum profit you can make.
So you're creating a strategy with a built-in range of potential outcomes. You're limiting your losses if the stock price stays low, but you're also limiting your profits if the stock price goes much higher than the strike price of the call option you sold.
Exactly. Bull call spreads are often used by investors who believe a stock will rise in price, but they want to limit their risk. It's a more calculated and controlled way to express a bullish view.
These advanced option strategies are fascinating. It's like Building with Legos, you can combine different pieces to create different structures and achieve different goals.
I like that analogy. And just like with Legos, there are endless possibilities with options. It all comes down to understanding the different pieces and using them strategically to achieve your desired outcome.
Okay, we've covered a lot of ground with call option strategies, but we have a few more strategies to discuss, don't we?
There are two more intriguing call option strategies we can explore: the protected short sale and the reverse hedge.
Intriguing indeed. I'm all ears.
Let's start with the protected short sale. As the name suggests, it involves short selling a stock, meaning you borrow shares and immediately sell them, hoping to buy them back later at a lower price, and simultaneously buying a call option on that same stock.
I'm seeing a theme here. It seems like a lot of option strategies involve combining calls and puts in various ways to create different risk profiles.
That's a great observation. You're starting to see the bigger picture. And you're right, the protected short sale is all about mitigating risk. Essentially, you're betting that the stock price will go down, but you're using that call option as a form of insurance, just in case you're wrong.
So if the stock price drops, as I predict, I profit from the short sale. But if it unexpectedly goes up, the call option protects me from unlimited losses. That's clever.
Precisely. The protected short sale is a way to express a bearish view on a stock while also managing the inherent risk of short selling.
Okay, I'm definitely adding protected short sale to my list of options techniques to research further. Now, what about this reverse hedge strategy? That sounds a bit more adventurous.
It's definitely a strategy that involves more risk and potential reward. The reverse hedge is a combination of short selling a stock and buying multiple call options on that same stock at different strike prices.
Wait, so you're shorting the stock and buying calls at the same time? That seems counterintuitive. Why would someone do that?
The key with the reverse hedge is volatility. You're not necessarily betting on the stock going up or down. You're betting that it will make a substantial move in either direction. If the stock price goes down significantly, your short sale will be profitable and those call options will expire worthless. On the other hand, if the stock price shoots up, the value of those call options will increase, potentially offsetting any losses from your short sale.
So you're trying to profit from a big price swing, regardless of which direction it goes. It's like setting up a net to catch the stock wherever it lands.
That's a good way to think about it. The reverse hedge is a volatility play. It's most successful when the market is experiencing big swings, but it can lead to losses if the stock price stays within a certain range.
This one definitely sounds like it requires nerves of steel and a deep understanding of how options work. It's not something I'd jump into without doing a lot more research.
I agree. It's a complex strategy that requires careful planning and a willingness to take on more risk. But for experienced options traders who understand how to manage volatility, the reverse hedge can be a powerful tool.
We've covered so much ground in this deep dive. From basic call options to these fascinating advanced techniques, it's amazing how many different ways there are to use options strategically. But we've only scratched the surface, haven't we?
Absolutely. The world of options is incredibly diverse. There are so many more strategies and nuances to explore, and there are even more complex options beyond calls and puts. But that's a topic for another deep dive.
Okay, I'm already making a note for our next options episode. But before we get ahead of ourselves, let's take a moment to reflect on everything we've learned so far.
That's a great idea. In the final part of this deep dive, we'll revisit some of the key takeaways and explore how this knowledge can help you make smarter decisions when it comes to options. Welcome back to the deep dive. In parts 1 and 2, we talked about a lot.
We really have. I feel like I've learned so much. Starting with, what options even are, to all these crazy strategies with names like reverse hedge. It's wild.
It is a lot to take in. But even if you don't remember every detail about bull call spreads or ratio rights,
Which, by the way, I still need to Google later.
the important thing is understanding the core concepts. Like you said, what options are those contracts that give you choices? The right but not the obligation to buy or sell. And then calls and puts. Which direction you think the stock price will move, up or down?
And don't forget those factors that make option prices go up and down, like the stock price itself, of course. But also how much time is left before the option expires. And volatility, too.
Right. So even if someone's not planning to become an options expert tomorrow, I think what we've done in this deep dive is show that options aren't this scary, mysterious thing that only Wall Street insiders can understand.
Yeah, I used to think of options as something only like day traders used, people trying to get rich quick. But it seems like options can actually be a useful tool for regular investors, too.
Absolutely. You can use them to potentially make more money from a stock you already own, like we talked about with covered calls. Or you can use them to limit your risk.
And maybe even generate some extra income.
Exactly. But like with any investment, the key is to educate yourself and really understand the risks involved.
It's tempting to hear about those big potential profits and think, sign me up. But it's so important to remember that there's always the possibility of losing money, too.
Right. And that's why it's so crucial to start slow. Build your knowledge gradually. Maybe start with paper trading.
Oh, yeah, paper trading. That's where you practice trading without actually risking any real money.
Exactly. It's a great way to test out different strategies, see how things play out, get comfortable with the mechanics of options trading before you put real money on the line.
So for anyone listening who's feeling a little overwhelmed by all this options talk, what's the one piece of advice you'd give them?
Don't be afraid to start small. Learn the basics. Practice with paper trading. And most importantly, remember that investing is a long game. Whether you're using options or sticking with stocks and bonds, it's about making smart decisions over time, not chasing quick wins.
Couldn't have said it better myself. Well, that wraps up our deep dive into the world of options.
Hope you all enjoyed it and learned a thing or two.
If you did, be sure to subscribe to the podcast and leave us a review. We'll be back soon with another deep dive into a fascinating topic. Until then, keep learning, keep exploring, and as always, invest wisely.